question. Is your money actually safe? When you walk into a branch or just pull up your banking app to deposit your paycheck, all right, let's jump right into this explainer and, well, we're probably going to shatter a comforting illusion you might have about your hard-earned savings. Today, we are peering under the hood of the foundational system that literally powers our entire modern world. It's something we interact with every single day, but we almost never stop to think about how the gears actually turn. So we're going to unpack exactly how banks function, dig into the reality of fractional reserve banking, and answer the ultimate question. Is your money actually safe? When you walk into a branch or just pull up your banking app to deposit your paycheck, you probably assume your money is sitting safely in a vault, just waiting for you to come back and claim it. We all kind of have this cartoonish image of a massive steel safe with our names on it on a neat little stack of bills, perfectly preserved. But spoiler alert, that couldn't be further from the truth. The banking system actually operates on a completely different set of rules than a simple storage locker.
The terrifying truth? Your money is already gone. Your balance is essentially just a number in a database. If every single customer marched down to their local branch and demanded their cash today, the entire system would instantly implode. There is absolutely no way the bank has all that cash on hand to pay everyone back at once. Why? Because the exact second you handed it over, they put that money to work in investments, loans, and other financial instruments.
Now, to really wrap our heads around this, we have to grasp the sheer scale we're dealing with. There are over 44,000 banks worldwide, and together, they manage hundreds of trillions of dollars in assets. It's this massive, globally interconnected web, where a single action by a bank in Tokyo can directly impact the cash flow in London or New York. Yet, despite the fact that we rely on this colossal network just to buy groceries or pay our rent, very few of us actually understand what these institutions are doing with our deposits. Okay, so let's back up a second. It all starts with the very nature of money itself. Thousands of years ago, people stored physical grain or metals. That eventually evolved into carrying paper receipts for deposited gold. But in 1971, the US dropped the gold standard entirely. We now use what's called fiat currency. That means our money is no longer a receipt for a chunk of physical gold stored in a vault somewhere. It's backed by absolutely nothing but our collective trust and belief in the system. That massive psychological shift changed the game entirely.
And that trust, that brings us to the absolute core engine of the entire banking world, fractional reserve banking. Because our money is based on trust, and because historically people rarely all demanded their money back at the exact same time, banks realized they don't actually need to hold on to everything. They are legally allowed to keep just a tiny fraction of your deposits in reserve while lending out the vast majority of it to other people. It's a wildly efficient way to keep capital moving. Let's actually break this down step by step because it's honestly fascinating. Step 1, you deposit $1,000 into your account. Step 2, the bank keeps maybe just $100 of that in their actual cash reserves to handle everyday, normal withdrawals. Step 3, they turn around and immediately lend the other $900 out to someone buying a car, purchasing a house, or maybe starting a small business. They are taking the money you gave them and throwing it right back out into the world to generate economic momentum. Now here's the real kicker, how this generates profit. Let's be clear, banks are not public utilities. They are highly optimized, extremely profitable businesses. They might pay you a measly 2% interest for the privilege of holding your funds, but then they turn right around and charge borrowers 12%, 18%, or even 25% interest for that exact same money. They are quite literally charging other people a massive premium for the money that you gave them and pocketing the difference. But hey, before we write banks off as just profit-hungry machines, we really have to look at their vital role in society. Economically speaking, a saved dollar just sitting idle practically doesn't exist. It doesn't build a house. It doesn't invent a new technology. Banks act as the ultimate middlemen here. They connect the people who have money they aren't using right now with the people who desperately need money to build something productive. They are the essential matchmakers of the global economy. Okay, this next part is literally mind-blowing. It's the multiplier effect. Remember that $900 the bank lent out for a car? Well, the person who sold that car takes that $900 and deposits it into their own bank.
Then that new bank keeps $90 and lends out $810. Through this endless looping cycle of lending, spending, and redepositing, your initial $1,000 deposit creates this massive ripple. By the end of it, that single grand eventually accounts for around $10,000 of actual economic activity. And that ripple effect perfectly illustrates why we absolutely need this system. Without banks taking these risks and continuously circulating our money, our economy would be a fraction of its size. This massive, flowing pool of deposited money is what actually funds the city bridges we drive on. It funds billions of dollars in cancer research, buys new factory machinery, and creates countless jobs. Money might get called the root of all evil, but in this system, it is undeniably the root of most societal progress. To manage a beast this big, the industry splits into distinct lanes. Retail banks handle the everyday stuff, your checking accounts and debit cards. Commercial banks cater to businesses, helping, say, a local restaurant open 3 new locations. And then you have investment banks, orchestrating massive, complex corporate mergers or taking tech companies public. But the crazy thing, every single one of them runs on that exact same fractional reserve principle. Okay, let's shift gears and look at the darker side. What happens when it all goes wrong? Because as much as this system drives incredible progress, it is inherently fundamentally fragile. It relies entirely on human psychology. And when trust evaporates in a fractional reserve system, that delicate balance shatters and disaster strikes fast. The illusion that everyone can have their money at once completely falls apart. And we're not just talking about old black and white photos of the Great Depression here. We saw this in real time in 2023 when Silicon Valley Bank collapsed practically overnight. Panic spread like wildfire on social media, and thanks to modern banking apps, customers tried to yank their money out with a few taps on their phones all at exactly the same time. The requests came in at lightning speed, and as we established earlier, the cash simply wasn't there. It was tied up. Billions of dollars basically vanished in an instant. When things fall apart, it usually happens in one of 3 major ways. First is your classic bank run. Pure panic, everyone rushing for the exits at once. Second is bad loans. This is when banks get greedy and overload on risky debt that borrowers simply can't repay. That's exactly what triggered the 2008 mortgage crisis. But the scariest one? Contagion. Because banks constantly borrow from each other, one interconnected bank failing can trigger a devastating global domino effect. So who stops the dominoes from falling? To prevent total economic catastrophe, countries rely on central banks. Here in the US, that's the Federal Reserve. They act as the ultimate backstop, basically serving as the bank for the banks. Their main job is to regulate this highly intertwined system, and they do it by walking a constant, stressful tightrope known as the dual mandate, aggressively trying to keep inflation low without sacrificing high employment. They manage this delicate balance almost entirely by tweaking interest rates. Think of it like a faucet. If inflation is running too hot and prices are out of control, they raise interest rates. That makes borrowing money way more expensive, which slows down loans and cools the economy off. On the flip side, if unemployment is spiking, they drop those rates. Suddenly, borrowing is cheap, businesses take out loans, and job growth gets stimulated to get things moving again. So, that brings us back to you and your money. The banking system is undeniably a marvelous, complex engine of human progress. It moves idle capital exactly where it's needed most to literally build our future. But it is built entirely on trust and the strict mathematical reality that we won't all ask for our money back today. So, the next time you check your bank balance, ask yourself, are you cool knowing your money is out there fueling the world? Or does the underlying fragility of the whole thing leave you wishing for a good old-fashioned steel vault?